Low interest rates have historically been the prescribed reforms, plus fiscal stimulus measures such as targeted infrastructure initiatives may be necessary ingredients, or perhaps are necessary ingredients, to incentivize capital investment in GDP growth. But as we pursue these policy changes, we also have to be mindful of a nearly $20 trillion national debt that looms ominously over the U.S. economy. Where debt to GDP stood at 39.3% in 2008, it will total 76.6% by the end of this year, according to the CBO analysis, and will climb to 85.5% over the next 10 years. We look forward to hearing the Chair's thoughts on this economic outlook, as well as the types of policies that Congress perhaps should be looking at and considering during this time of change. I now recognize Ranking Member Maloney for her opening statement.
Thank you. Thank you so much, Mr. Chairman, and for your leadership. This is likely the last hearing of the Joint Economic Committee in the 114th Congress, and I'd like to sincerely thank Chairman Coates for his stewardship of the JEC and for holding a number of very interesting hearings that have generated excellent discussion. I'd also like to thank my colleagues on both sides of the aisle and to welcome Martin Heinrich as the ranking member on the Democratic side, and to express my appreciation to Ms. Klobuchar, who is going, I understand, to be ranking on rules. I'm particularly pleased that we are ending on a very high note with Federal Reserve Chair Janet Yellen. Chair Yellen, I think it's fair to say that all my colleagues warmly welcome you to this hearing and look forward to hearing your thoughts at this critical time. I'd like to begin by thanking you for your extraordinary and careful leadership of the Federal Reserve. The Fed has played a critical role in helping our country recover from the worst recession since the Great Depression. Your steady hand has built on the work of your predecessor and has guided the economy forward, and we thank you. Much has changed since you appeared before the committee about a year ago. The economy has continued to strengthen. The labor market has continued to improve. Wage growth has been the strongest since the recession. Household income has had the largest annual increase since census began tracking this data. Inflation has edged up, though it remains below the Fed's 2% target. These are among the tea leaves of the economy, and everyone here is eager to find out how you read them. Up until very recently, it was widely assumed that the Federal Open Market Committee would raise interest rates at its next meeting less than a month from today. Some of your past statements have indicated that this is a possibility or even a goal. But then came a thunderbolt on November 8th. Many critical changes about our country changed literally overnight, and our world has been turned upside down. The question everyone would like to know is how the Federal Reserve will steer through the days ahead. One particular challenge is that the President-elect has called for policies that may have countervailing effects. History has shown us that the type of tax cuts candidate Trump has proposed disproportionately benefit those who don't need them and dramatically increase our national debt. I'm also curious to see how President-elect Trump's infrastructure plan be reconciled with the Republican Congress's past opposition to fiscal stimulus. There is a great deal of uncertainty about fiscal policy, and that leads to uncertainty for markets, businesses, and the economy overall. One constant that I have is that we can count on is monetary policy that remains insulated from political attack and attempts to meddle in any way with the Federal Reserve's independence. The President-elect's comments on this subject have been somewhat contradictory. He thinks both that the current low interest rates are good for the economy and that the Fed has been being political and keeping them at these levels. In Congress, some have called for revolutionary changes for the Federal Reserve, changes that would affect the very nature of the institution, changes that, in my opinion, would lead to disaster. For those who would like to restrict the independence of the Federal Reserve, I think it's important to briefly review that immense benefit of an independent Federal Reserve. We have only to look back a few years. When President Obama took office, he inherited from what former Fed Chairman Ben Bernanke called, and I quote, "the worst financial crisis in global history, including the Great Depression," end quote. The Federal Reserve quickly acted to lower rates to almost zero and has held them there for about 8 years. It instituted several rounds of quantitative easing to further stimulate the economy. This action by the independent Federal Reserve was critical to our recovery. Economists Alan Blinder and Mark Zandi found that efforts by the Federal Reserve and the Obama administration, with support from Democrats in Congress, dramatically reduced the severity and length of the Great Depression and recession and prevented a depression. With control of the legislative and executive branches, year, Republicans in the House passed legislation, the FORM Act, that would fundamentally hamper the Fed's ability to conduct monetary policy. It would limit the Fed's independence by forcing it to determine target interest rates using a mathematical formula, while ignoring a broad range of important economic indicators. Chair Yellen, as you noted before, if the Fed had been forced to follow such a rule in recent years, and I quote, millions of Americans would have suffered unnecessary spells of joblessness over this period, end quote. Another proposal to jettison the Fed's mandate to try to maximize employment and instead focus solely on inflation. I'm not sure that people in Michigan and Pennsylvania and other states would respond well to that suggestion. But if that's the conversation my colleagues want to have, then we'll be ready to have it. The past 9+ years have been an extraordinary period in the U.S. economic history. We should continue to study and learn from it. We are not out of the woods by any stretch. When the next recession hits, as it surely will, what will the monetary response look like? Will the Fed have the tools to restore growth? Will it return to quantitative easing? What other effective policy tools will the Federal Reserve have at its disposal? I want to make one final point. The Federal Reserve has been at the center of the U.S. and global economic recovery. Efforts to hamstring the Fed are misguided, just as efforts to politicize it are wrong-headed. Chair Yellen, thank you for appearing before the Joint Economic Committee today. We look forward to your testimony. Thank you.
It's now my privilege to introduce to you Chair of the Board of Governors. Janet Yellen has long experience at the Federal Reserve, including 4 years as Vice Chair of the Board of Governors and 6 years as President and Chief Executive Officer of the Federal Reserve Bank of San Francisco. She previously served as Chair of the Council of Economic Advisors under President Clinton and as Chair of the Economic Policy Committee of the Organization for Economic Cooperation and Development. Chair Yellen earned her Ph.D. in economics from Yale University and is also Professor Emeritus at the University of California at Berkeley. It is my pleasure, Chair, to introduce you as our witness today and to thank you for your always accessible presence for this committee. You've been someone that has been a delight to work with and to get your guidance in terms of the direction that we think the Fed needs to take in order to assure our public and that there's a steady hand at the helm. So we thank you for coming this morning and look forward to your testimony, and then we'll have questions from our committee.
Thank you for those kind comments. It's my pleasure to be here. Chairman Coates, Ranking Member Maloney, and members of the committee, I appreciate the opportunity to testify before you today. I will discuss the current economic outlook and monetary policy. The U.S. economy has made further progress this year toward the Federal Reserve's dual mandate objectives of maximum employment and price stability. Job gains averaged 180,000 per month from January through October, a somewhat slower pace than last year, but still well above the estimates of the pace necessary to absorb new entrants to the suggests that the U.S. economy has had a bit more room to run than anticipated earlier. This favorable outcome has been reflected in the labor force participation rate, which has held steady this year despite an underlying downward trend stemming from the aging of the U.S. population. While above-trend growth of the labor force and employment cannot continue indefinitely, they're above the median of Federal Open Market Committee participants' estimates of its longer-run level, and involuntary part-time employment remains elevated relative to historical norms. Further employment gains may well help support labor force participation as well as wage gains. Indeed, there are some signs that the pace of wage growth has stepped up recently. While the improvements in the labor market over the past year have been widespread across racial and ethnic groups, it's troubling that unemployment rates for African Americans and Hispanics remain higher than for the nation overall, and that the annual income of the median African American household is still well below the median income of other U.S. households. Meanwhile, U.S. economic growth appears to have picked up from its subdued pace earlier this year. After rising at an annual rate of just 1% in the first half of this year, inflation-adjusted gross domestic product is estimated to have increased nearly 3% in the third quarter. In part, the pickup reflected some rebuilding of inventories and a surge in soybean exports. In addition, consumer spending has continued to post moderate gains, supported by solid growth in real disposable income, upbeat consumer that resulted from earlier declines in oil prices. Manufacturing output continues to be restrained by the weakness in economic growth abroad and by the appreciation in the U.S. dollar over the past 2 years. And while new housing construction has been subdued in recent quarters, despite rising prices, the underlying fundamentals, including a lean stock of homes for sale, an improving labor market, and the low level of mortgage rates are favorable for a pickup. Turning to inflation, overall consumer prices, as measured by the price index for personal consumption expenditures, increased 1.25% over the 12 months ending in September, a somewhat higher pace than earlier this year, but still below the FOMC's 2% objective. Much of this shortfall continues to reflect earlier declines in energy prices and in prices of non-energy imports. Core inflation, which excludes the more volatile energy and food prices and tends to be a better indicator of future overall inflation, has been running closer to 1.75%. With regard to the outlook, I expect economic growth to continue at a moderate pace, sufficient to generate some further strengthening in labor market conditions and a return to the committee's 2% objective over the next couple of years. This judgment reflects my view that monetary policy remains moderately accommodative and that ongoing job gains along with low oil prices should continue to support household purchasing power and therefore consumer spending. In addition, global economic growth should firm, supported by accommodative monetary policies abroad. As the labor market strengthens further and the transitory influences holding down inflation fade, I expect inflation to rise to 2%. I will turn now to the implications along with the return of inflation toward the FOMC's 2% objective. In September, the committee decided to maintain the target range for the federal funds rate at 1/4 to 1/2% and stated that while the case for an increase in the target range had strengthened, it would, for the time being, wait for further evidence of continued progress toward its objectives. At our meeting earlier this month, the committee judged that the case for an increase in the target range had continued to strengthen, and that such an increase could well become appropriate relatively soon if incoming data provide some further evidence of continued progress toward the committee's objectives. This judgment recognized that progress in the labor market has continued and that economic activity has picked up from the modest pace seen in the first half of this year. And inflation, while still below the committee's 2% objective, has increased somewhat since earlier this year. Furthermore, the committee judged that near-term risks to the outlook were roughly balanced. Waiting for further evidence does not reflect a lack of confidence in the economy. Rather, with the unemployment rate remaining steady this year, despite above-trend job gains, and with inflation continuing to run below its target, the committee judged that there was somewhat more room for the labor market to improve on a sustainable basis than the committee had anticipated at the beginning of the year. Nonetheless, the committee must remain forward-looking in setting monetary policy. Were the FOMC to delay increases in the federal funds rate for too long, it could end up having to tighten policy relatively abruptly to keep the economy from significantly overshooting both of the committee's longer-run policy goals. Moreover, holding the federal funds rate at its current level for too long could also encourage excessive risk-taking and ultimately undermine financial stability. The FOMC continues to expect that the evolution of the economy will warrant only gradual increases in the federal funds rate over time to achieve and maintain maximum employment and price stability. This assessment is based on the view that the neutral federal funds rate, meaning the rate that is neither expansionary nor contractionary and keeps the economy operating on an even keel, appears to be currently quite low by historical standards. Consistent with this view, growth in aggregate spending has been moderate in recent years, despite support from the low level of the federal funds rate and the Federal Reserve's large holdings of longer-term securities.